Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's going to be related to three topics: financial topics, wealth building, and/or commodity topics. Those are the big three that I cover. And we'll get in here and see what people are sharing. So let's dive in, see what people are talking about, and I'll give you my financial opinions. If you want to follow me, it's at finding_finance. If you want to join our community, finding-value.com, that's where the magic happens with individual companies, sharing my opinions on those individual companies. And you can see what I'm buying and my portfolio. Fun fact, 100K in taxable brokerage is worth more than 100K in a 401K. Why? You still owe income taxes on every dollar of future 401K withdrawals, but only the gains and dividends are taxed on brokerage withdrawals. And if investments are held at least a year and dividends are qualified, taxes are at the lower capital gains rates. But what he is not telling you, 100K in a 401K would not be the same amount in a taxable brokerage because you'll have to pay taxes up front. If you are a high income earner, and that it's being taxed at a 30-something thousand-dollar tax rate, that means in a 401K, you get full purchasing power of that money to make money on. In a taxable brokerage account, that's after-tax money that you are using. So you have to balance your after-tax money and pre-tax money if you put it in a 401K pre-tax. Then you have to determine that. Now, there's also Roth 401Ks where you take after-tax money, which would be this after-tax money, put it into a Roth 401K, and then you can earn income and take it out all tax-free in a Roth 401K. And you'll have to talk with your employer or look at the plans that they provide to see if they have a Roth 401K. Now, I'm not a tax advisor. You're going to have to do whatever is best for you and your family and your situation. And I don't know your guys' situations. For me, and what I've done through history is when I was making good money but had a lot of tax write-offs, a lot of kids on there, I did a Roth 401K. And then as my income went up and it went to levels where I was getting pushed into higher and higher tax brackets, I started and went to a pre-tax contribution in a 401K. But when you take the money out after you're done working, your income will go down. So I have a good mix between Roth 401K, a pre-tax 401K, and then I have also a Roth IRA that you can also put money into on top of all of this. And there is limits to how much you can put in a Roth IRA. And it depends how much income you have as well. And you might have to do a backdoor Roth IRA. So there's a lot of things you have to do, but that is one thing. You have to balance between paying the taxes up front and how much money you can make off the pre-tax money, because I think you need a combination of both things. That's what I've done. Coming on back, we've got this time war is being fought by the banks. Got gold, silver, uranium, and crude oil. Now, this is what's really, really important to understand. These are the tailwinds behind your investments, guys. And all of this data that I'm showing you is supportive of a commodity bull market and gold, precious metals, all of those things. So when we look at last 2002 all the way down to the bottom of 2011, we saw a bull era for commodities: gold, silver, uranium, and oil. And obviously, we had the big crash in 2008-9, where we had a major sell-off due to a deleveraging event in the middle of that from real estate. But if you notice, Germany outperformed in this type of scenario. We had a bull area for US equities here. This is your recovery phase of real estate from 2011 all the way up to about 2020. We had that blow off top in 2020, blow off bottom in oil, blow off bottom in interest rates, et cetera, et cetera. That was the bottom, the capitulation top for the bull era for US equities, and the capitulation bottom that we got in a lot of the commodity sectors. This fell pretty hard in 2020, 2021. We started working our way back up, but it was a pretty weak move to the upside, and then we get hard selling pressure here in 2023. And we've broken to the downside of this support level, and we're about to head lower. This is the bull era for commodities: gold, silver, uranium, oil, copper, doesn't really matter, all of those things. And what we look for is the power zone for gold, power zone for gold down here. And then this is the power zone for US equities. What this is a measurement of is the market conditions where certain assets perform well under. And this is not the only thing that's telling us that this big commodity bull market, it is absolutely everything that I'm showing. Big long picture charts of ratio charts breaking out where we've got bottoming patterns, they're breaking out of things. Of various assets versus various assets. And it's all supportive that I've seen of basically falling wedges and all these gigantic 15, 20, 30 year, 40 year, 50 year patterns that are squeezing up. This is, in my opinion, the most important time of anyone's life to get better at investing quickly because the opportunities are here right now. When this drops, you're going to see everything start to move more quickly. And you want to be positioned for that move, in my opinion. I mean, that's how I'm positioned. And I think it's coming very soon. So you better get ready. It is coming. Two monster crude draws in a row as reported by API. So we still have this strong demand. We're still have monster crude oil inventory draws of commercial inventory. I am surprised at how cheap crude oil is still, and the negative sentiment towards crude oil. I think that we are probably close to a bottom. I think that we're going to work our way on out. It's just going to take a little bit of time. A bullish oil options wager on rally beyond 110 in coming months, says Bloomberg. So it looks like some other people are also bullish oil and are starting to put some wagers in the options market. Well, that's interesting. Uranium, URNM versus SILJ. Negated shoulder, head, shoulder, back above the neckline. Now, I wanted to make a comment about this. This is from Casper. It's a good chart. But I want to comment about something that I think people are missing here. This is a shoulder, head, shoulder. We went to break to the downside, and interest rates were the driver of this, a lot of it. Interest rates were driving this rotation into silver and into gold. But we're seeing strength in yields recently. And I think that's why this is turning. It's really slowed down gold. It's slowed down a lot of the gold and silver mining companies. And it's turning in favor of crude oil here and of uranium. So we are watching the ratios. We're looking at this. We saw a market condition coming where we could potentially see a slowdown. And all of a sudden, the market turned on a dime and interest rates are behaving differently, which is then pricing assets differently. You need to be watching those interest rates. Scrolling down. Okay, what just happened? We've got all of these uranium guys ripping to the upside. Now, here's something that I'll talk about. You shouldn't be chasing price. You shouldn't be affected by the price movement. I know everyone is absolutely gung-ho on uranium. You should be gung-ho already. You should have already been positioned, twiddling your thumbs, hitting refresh on the portfolio, waiting for these to go up. I know, what was that? That was back, it's been a while now. A lot of the positions that we entered on the website, they're up 50 to 100% in uranium since our last purchase point. I even made a comment. I said, guys, this is where I'm going to be buying, and I'm not going to know what to say when we get to this level that we're at today. Because people are going to ask me, well, is this a good time to buy? And I'm going to say, I don't know, because You should be locked and loaded and ready to be riding. You should already be up 50, 60, 70, 80, 90, 100% on a lot of these positions. And we picked some pretty good ones, I think. We picked all the high leverage developers. The Namibian crew is what I like to call it. Um, this guy here we like very much. And these other ones I'm not as keen on compared to some of the other ones. So yeah, that's what I'll say there. Oh, this is my big boy. This is 10 Baggerman here. 10 Baggerman. So we got in right here at the tip, 90 cents to a dollar, somewhere in that range, right on the tip there for the website. And we're holding on, holding on. We've got another flag pattern that we're going to break, and now we've got the big long-term downtrend line that's going to break here. I love Little Banny here. It is a company over in Namibia. It's got a lot of leverage to the price move of uranium. It is a higher cost producer, and I think this thing's going to rip. Like, I know some people got creeped out a little bit. On Twitter, I saw some people selling some uranium, and I'm just shaking my head, guys. Uranium, the futures pricing is being very, 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 very good. It is ripping. Why are we selling into the rip? I'm gonna hold this rip. I'm gonna wait until this thing really starts to rip to the upside. And when I start to see a pattern, now I think this is gonna go quite a long time, guys. I think this could last for a couple of years. This I think is wave one, wave two, and I think wave three is we're in the mix here, and I think it could last a little while. Much like this point here is probably before even this, before this big vertical move. The vertical move hasn't happened yet, but it could happen at any time. So be all I can say is don't mess this up. I messed up a lot of stuff last bull market. I was just a little guppy trying to find my way. I really made a mess of things trying to time the market. When these things rip, they rip like a lot. And it is psychologically, for me, it's psychologically impossible to re-enter something like this. Let's say it's at $2 and something cents, whatever the price is right now, and it goes to like four and a half, five. I can't buy it there psychologically. I don't like to run and chase things. So what I did is I purchased towards the bottom here in October, September of 2020. And I've been riding this thing up, and I bought a bunch more in this general region down here too. And I'm gonna ride this thing. I'm gonna ride. And that goes for all my other oil and gas, energy service. We are in the heart of this commodity bull market in an expansionary phase of real estate. That is exactly every single time that the uranium bull market has hit, it has hit at this time frame. All I want to tell everyone is don't mess it up. Hold through it if you can. That is my experience. There are many reasons why insiders sell, but only one reason they buy. And despite plenty of volatility with WTI and NYMEX prices, management insiders continue to pick up oil and gas stocks in November, December. This should give investors confidence heading into 2024. So Canadian oil and gas total insider buying, you can see these big time frames where they purchased quite a bit. We just got into this November, December, and then we got a lot of insiders purchasing. That's a very good thing. I also purchased here recently in December and even here in January. I've been a buyer in even Canadian oil and gas, but energy service, oil and gas, I think it looks really good. So here is Sprout Physical Uranium Trust. What a good looking chart. So he's got the Jesse accumulation, Livermore accumulation cylinder. I love this cylinder, guys. 1, 2, 3, 4, 5, 6, 7. Boom. We are ripping in the middle after 7 here. And we're probably just above the accumulation cylinder somewhere in here. And we'll probably get a pause somewhere at some point and then rip again. So that's kind of where we're at. And I don't know why you would sell at this time because this thing looks fantastic. Just gonna hold on to this bad boy. Don't let the bull buck you off, guys. Mike Simonson says, okay, so the arc of happiness. I wanted to talk about this too. Self reported happiness graphed by age is smile shaped. The optimism of youth becomes cynicism as responsibilities mount and dreams collide with reality. But after midlife, happiness rises again as people accept reality and learn to enjoy the small things. So this is relationship between happiness or life satisfaction and age across 7 major surveys. I would say I would say mine's going to be like the orange line. Uh, Maybe not as far as a dip here. I really liked my early 20s. Like I would say all my teens all the way up to my early 20s. That was a pretty good time. It was basically no responsibility, pretty happy. I think I definitely did not like work and stuff in my kind of my 30s. Now I think I'm rebounding at 42, 43. So I think I'm starting to come back up. You know, I agree with this chart. I would say it's pretty accurate, definitely. And I'm sure all these guys in the 9 to 5s are going to be following the yellow line, peaking right after they retire or something like that. In a bear market, these lines go up because they're defensive. In bull markets, these lines go down because they are defensive. And here they are rolling back over. I know some people on Twitter were talking about utilities doing very well. These are consumer staples versus S&P 500, but I think I'm not so sure about the S&P 500. I'm not a huge bull on it. Generally, in these expansionary phases of real estate, you'll see S&P 500 go up, but it'll also go sideways for a long period of time, and it could even pull back during certain periods of increasing interest rates. So I think the better play is commodities, gold, silver, those types of things. And given the first chart that we looked at, the US dollar and Germany and stuff like that, we're coming into the power hour here where commodities are just going to rip. And we're probably going to see a little bit lower dollar. Now, that doesn't mean the S&P 500 can't go up. I'm not saying that. I'm just saying I think commodities are going to rip. Stuff like uranium. Since my wife and I are shopping for car insurance, I asked for several quotes yesterday. Progressive came in at $120 cheaper per month, full coverage than what we are currently paying. It would cut out auto insurance bill in half. We should have looked sooner. What do you use? I use Safeco. My insurance is like I have 4 cars, 2 drivers. I think it's like $2,000 a year. I think for 4 cars, but I only have liability on them. I don't have full coverage. The median age of a home buyer has risen from 31 years old in 1981 to 49 years old in 2023. Is that right? I thought it was 36 or 37. Median homebuyer age hit 49 years, median age of all home buyers. That's crazy if that's the case. It was 31 back in the 80s, and then you can see it steadily is climbing over the years. Wow. A friend of mine just bought a new car. He paid cash, almost 30,000 bucks. People will say he should have financed it and invested the money instead. I think he made a great decision. He's debt free and will make up 30,000 in a year or less. Financial decisions like this are going to make him a millionaire. Well, I can tell you this, guys. I'm not going to be a millionaire. I am a millionaire. And what I did is I don't even spend this on cars. I just go buy a used car. And you can find cars if you're pretty handy in fixing stuff. You can find cars for 5,000, 6,000, 7,000, 8,000 bucks. That's what I would do. I would pay cash for a car that's 5, 6, 7, 8 grand. And if you really want to get dirty, I bought a car for 1,500 bucks. Well, actually, it's $1,200 to be exact. I bought a car with a crappy engine in it. I swapped the engine in it. It probably ended up costing in total of what I put in the car, probably 5 or 6 grand with me doing all the work. That was all parts, a new engine. I put in a different transmission in it, manual transmission, and I love that thing, dude. I love it's the RX-8 that I purchased back in 2015. The engine costs $2,900. I put some other stuff on it. I put coilovers, some other stuff. But that thing is a blast. I would do the same thing with some of these other cars. And where I really make up is I don't spend much money. I don't spend much money. I fix everything myself. I get highly annoyed if I have to pay someone else to do something. So I just do it myself. I learn it, do it myself, save a whole heap of money. So $30,000 to them. Now, here's another thing to think about. This guy's going to put full coverage on his car. He's going to pay high registration costs. So his insurance costs and registration costs are going to be way higher than something like me. I pay $60 for registration costs on an old car, and I do liability only, which cuts my insurance way down. So all my cars are old. I have liability on all of them. And if something gets wrecked or whatever, it's like, yeah, I don't care, whatever. It just doesn't matter anymore. So that's my take on it. Inflation is an increase in the supply of money and credit. In November, consumer credit soared 24 billion bucks, 4 times expectations. Total credit now exceeds 5 trillion for the first time in history. Credit card debt soared by nearly 19.5 billion, the third highest monthly increase ever. So credit is expanding here, guys. That is inflationary. It's inflationary. Inflation is theft. So it says 10 of these would buy an average home in 1920. 10 of these will buy you an average home in 2023. Um, I would agree, but I would use my savings in this. Because if you have your savings in precious metals, you can do, the ratio game that I play where you swap between assets, but it also doesn't lose purchasing power. And you can gain more ounces of metal doing that, doing ratio investing. So use a ratio when maybe you'll swap to silver at one point and then you swap back to gold, or you're in palladium, you swap to platinum, which I'm in platinum now, and then you swap back to palladium when the ratio comes down, which it has been. And that's the game I play. A zinger from Bill Miller. He says 100% of the information you have about any business reflects the past, and 100% of the value of that business depends on the future. And that's what people, they're talking about looking at the balance sheets, looking at all these things. So just listen to this here. Most value investors weigh past data very heavily. As I tell our analysts, 100% of the information you have about any business reflects the past, and 100% of the value of that business depends on the future. So it is only to the extent that the future resembles the past or maps onto it in some kind of systemic way that historical data are useful or assessing value. So one thing that I will say here is that is what the market conditions are for in my 3 pillars. We are looking at the future and trying to say, you know what, I think a commodity bull market's coming because these things are coming, or they have hit these milestones where they're basically about to break. So the future value of these companies are going to go up, in my opinion, because of the market conditions, inflation, and all that other stuff. Current, new, and future uranium production. Any comments from the family? I was looking at this boss. We've got Paladin, Energy Fuels, Peninsula, Global Atomic. You can kind of see when these all come in at certain areas. Encore Energy, Denison, Fission, maybe 2029. Next Gen over in 2028. I think these are highly aggressive, some of them. And remember, uh, I don't know who they have on these guys as teams. They may not come into production because they don't have the critical skill sets to get the mines built, done, and producing. There's a lot of risk there in starting up mines. This is where the rubber meets the road. More of those big charts that I always talk about that all signal that a commodity bull market's coming. Historical massive asset paradigm shift is in the making. As said now for almost 4 years, the commodities bull will be the greatest opportunity. So he's got a falling wedge. We've broken out of the falling wedge. We've done a return back test move. So 15-year perfect bullish falling wedge back testing. And we're about to run up where gold's going to outperform tech. No one is positioned for this outside of me and people who listen to this channel. Everyone's over in tech, and these guys are going to get beat by gold soon. It's going to take some time, but it will be soon. It says you can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating. And it's critical that you understand why the market isn't seeing the value. Not seeing the value here, guys. They're all over in NASDAQ. They're chasing price. The value is where gold's at, and silver and platinum and all these other commodities. Here's AutoZone, the anatomy of share cannibal. So I'm going to read these four things. So long-term industry tailwinds over the last. So I'm going to read the big four. Long-term industry tailwinds, and that's what we look for in the market conditions, are tailwinds, competitive advantages, simple capital allocation strategies, and a cheap valuation. Ratios tell you the cheap valuation. Capital allocation strategy, that depends on the company and how they're dealing with it. Competitive advantages, it could be their assets. And then you've got long-term industry tailwinds, which is the inflation coming into the system. But look at AutoZone and the total shares outstanding and free cash flow per share. The free cash flow is just going up massively, and they're buying down their total shares outstanding. They're doing buybacks, share buybacks. What they're doing is they're shrinking the share count at the same time that they're increasing their free cash flow. You're going to see this in a lot of the oil companies. They're going to shrink their cash flow and then or shrink their shares outstanding and just jump their cash flow. It's going to be insanely awesome for those that are shareholders for a lot of these energy service companies and oil and gas. Another one, BKNG, Apple soon joining the list. Companies so efficient that they're able to return all cash to shareholders, effectively having a negative equity. In short, they are rewarding shareholders with other people's customers and credits money. Okay, we're in the things here. Hold on. Come on down. Howard Marks, spot on as always. Price drives narrative. Price drives narrative. The price of an asset is based on fundamentals and how people view those fundamentals. So the change in an asset price is based on a change in fundamentals and or a change in how people view those fundamentals. Company fundamentals are theoretically subject to something called analysis and possibly even prediction. On the other hand, attitudes regarding fundamentals are psychological and emotional, not subject to analysis or prediction, and capable of changing much faster and more dramatically. So that is where the market conditions come into play. When you subject the herd to certain market conditions, they perceive value differently in the market. And when certain pressures enter the market, which pressures investors into losses, like the bond market going down, bond prices, assets in that market shift and the perception shifts of the herd. And the herd, people act as herd. They start to move to other assets. Money starts to rotate differently. And that's what I think is coming. That money's going to rotate into commodities, into oil, gas, energy service, uranium, all those commodity sectors and precious metals. It's coming here, guys. WTI historical quarter one average prices. Now check this out. I was just looking at this. We had 2 quarters up, 2 quarters down, or 2 years down. So 2 years up, this is all first quarter. 2 years down, 2 years up, 2 years down, 2 years up, 2 years down. Now we're going to probably have 2 years up. That's my guess. It seems like there's a cycle going on. I did listen to this interview here. He says the recession doomers need to stop taking their crazy pills. So he doesn't think there's a recession coming from, I can't remember his name, Joseph Wayne. Stocks will crush bonds as record fiscal deficits reignite inflation. That's that fiscal spending that I was unsure of, because if they continually fiscally spend, they're driving inflation. Nominal GDP growth will continue to be strong as long as the US government continues to print $2 trillion of helicopter money. Nominal GDP growth. Nominal. Everyone's looking at it from a real GDP growth. Nominal is going to hide it and cover it up. However, the 2023 disinflation will itself prove to be transitory, and the Fed will cut interest rates by less than the market expects. Currently, 6 cuts are priced in by the end of 2024. So he thinks there's going to be less cuts than that. Recent easing of financial conditions, rally in rates, stocks, and credit will boost economic activity, particularly the housing market. Particularly the housing market. This guy is right on. Fed is likely planning to taper quantitative tightening, which means that the shrinking of the Fed's balance sheet will continue even longer until the Fed's reserves approach the lowest comfortable level of reserves. We also discussed the draining of the reverse repo facility. Joseph was publicly talking about this literally 3 years. Now everyone is talking about it. And mortgage-backed securities role in QT. I asked Joseph if fall in rates will cause MBS prepays to rise. He says, I'm paraphrasing, technically yes, but it will be a very mild effect. So Joseph's got this thing nailed down, I think. I agree with what he's saying. I do agree. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Name a stock that is experiencing maximum pessimism right now, but their fundamentals are still strong. Energy, 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 energy. Oil and gas and energy service companies are in maximum pessimism right now, and I think they are fundamentally still very strong. We just saw the big oil draws in inventory. I think that's a really good spot to be looking right now. But that's where I'm at it, guys. So give me a thumb up for the content. Subscribe to the channel if you haven't. Subscribe to the website. We are doing a question and answer session coming up 8:30 a.m. today. If you want to join, I extended the holidays coupon. If you want to join and jump on the call, you can do that today. Right now, we're going to be having that call. I'll post it afterwards if you can't make it. I'll tape it, post it, but it's going to go over technical analysis, human psychology, a lot of these things that we're covering here, and we'll dive into looking at some of the companies and why I like some of the companies I like. What are the things I look for in the companies? So that's what I've got for today. We'll catch you guys next time. This is Finding Value.